right now, silver in Shanghai is 7.2% higher in Shanghai than in London, and gold futures are only a 0.5% higher than they are in London. But this higher premium, this arbitrage, again, is trying to entice what is left on the shelves to be moved over, whether it be to Shanghai or whether it be to COMEX. Look, I've been conditioned for so long to expect the other shoe to fall that it is somewhat surprising to see how fast it has gone higher. But I think markets go higher to the upside than anyone really ever thinks possible. And if you take a step back and you are really being honest with yourself, ask yourself, why would the most powerful bank in the world in 2019 reclassify gold as the world's only other tier one reserve asset? And along those lines, why would the most well-funded and well-informed traders on the globe, the central banks, go on a repatriation and a buying spree since 2017 that the world has never seen before? Why would that continue unabated? And bring it closer to home, why would the United States become net importer since November of the world's only other tier one reserve asset? And when we see the countries around the world that are voraciously accumulating gold, there's talks of it being pegged to a new system, as we were told by Dilma Rousseff, the former president of Brazil and the head of the new development bank, that they've agreed in principle to a new settlement currency called the unit, which is 40% gold backed and redeemable upon demand. And everywhere we look, from accumulation to repatriation to reclassification to slow moving higher, or even Judy Shelton, who you interviewed, who has told me flat out Trump is going, by her belief, will issue gold-backed treasuries next July, 2026, the 250th year anniversary. You put all of these puzzle pieces together in and of themselves, each one is significant, put them together, and it's almost impossible to not expect gold to go much higher. So yes, on one hand, as a guy who's been doing this since I was 19, for the last 35 years, I am surprised that it's moved in the manner that it has, as fast as it has. But when I take a step back and look at all of the pieces that are coming together quite eloquently, and outside the purview of the mainstream, mind you, which gives me more confidence that this is the right path, because the insiders never want to be too transparent about the direction that things are moving, yet they're positioning as if that is the direction that they're moving. To me, it becomes, well, yeah, that is pretty convincing that maybe indeed that is where we are heading. Quite frankly, I would be, if I were being completely honest, I would say that it's going to go higher than people think. You even got Goldman Sachs or UBS, one of the two, coming out and saying, yeah, you could actually see $4,500 gold by the end of this year if things get bad in the bond market with the basis trade or whatever it is that could trigger that, raising their their low end projections to north of 3,500. Yeah, I think perhaps we're going to see gold outperform people's expectations, mine included. It's abating a bit, but we're still seeing big deliveries. I mean, not quite as big as we were seeing in February, but even still, we're seeing it in the March contract. We saw big deliveries, 50 million ounces of silver delivered in the first day of the March contract, 70 million ounces of silver drained from the LBMA in January. That's an all-time record. We saw massive amounts in February, still seeing it in March. It's happening, but part of the problem is that, Adam, is that the exchange in London is a T+1 exchange, and meaning T is the trade day, +1 is a settlement. You're supposed to have it moving on its way over here in 3 days. They're now saying, well, sorry about that, Mr. Taggart. We know that you have a bunch of silver and gold that you have purchased that you need for your manufacturing, and you're expecting delivery, but it's now T+8 weeks because we do not have enough trucks and manpower to move that, which is really nonsense. It amounts to a default. So part of the reason you're seeing it abate is because the LBMA has put the brakes on how fast they're sending it over here. But the trend of accumulation has not stopped. And one of the ways that you can see that is you see this massive increase right now in the premium in Shanghai, where silver is priced, I don't know, I think it's $7 or $8 higher than the London price right now. And gold is much higher, also trying to arbitrage all of that over. So you'll continue to see it happen, but it's as if the LBMA has gotten a little bit wise to it. Right now, silver in Shanghai is 7.2% higher in Shanghai than in London, and gold futures are only a 0.5% higher than they are in London. But this higher premium, this arbitrage, again, is trying to entice what is left on the shelves to be moved over, whether it be to Shanghai or whether it be to COMEX. The trend is to take physical possession, and it's not stopping. Only on American Eagles so far. There was a big bullion bank in New York, according to my sources, that bought up a tremendous amount of the U.S. Mint allocation. And the U.S. Mint has hardly made any silver eagles really since Trump was inaugurated. So, yes, in both gold and silver on the eagles, it's bound to happen quickly across the entire spectrum. The first thing that happens typically just did happen, and that is that the backdates disappear. In other words, a lot of times you can buy coins that were issued from last year or beyond at a discount. Some of the online companies try and tell you that they should be traded at a premium. I always sell them as a discount. And we had a lot of them. We were sitting on inventory that much of the industry was choking on for quite some time, as we had for quite some time from the election all the way, even going back a year with the Mag 7 and the rise in NVIDIA and Bitcoin and Apple and all of this stuff. The premiums collapsed and the dealers were choking on inventory. And then came, Trump wins the election, and there's euphoria, and there's this new Trump trade and the risk on trade. And then came the 2025 allocations, where all the dealers like myself need to spend millions and millions and millions and millions of dollars buying the current stuff. The 2025 Eagles, Maple Leafs, Buffaloes, Philharmonics, Kangaroos, both gold, both silver, different sizes. I mean, you spend a fortune. And if you don't do that, then you drop down the pecking order very quickly on the big distributors, on the mints. If you're not there to take your allocations, well, they're not very happy. And when good stuff comes around, or when stuff's hard to get, you're not at the top of the list. So you had all of this inventory coming in, premiums collapsing as a result of it. Well, that backlog has pretty much been filtered out. And so I would argue that we are very close to seeing premiums across the board move much higher. And it's important to understand that my whole career, premiums were a function of production and distribution, where you take a blank piece of gold and silver, you stamp it, you put it in tubes, send in boxes, and send them out to the distributors. And like, as one of 27 U.S. Mint authorized resellers, if you buy $50 million worth of gold eagles from the U.S. Mint, they're going to charge you 3.2 or 3.3% over the price of gold to buy them. That's zero. That's your cost, and then anything above that is the profit. Well, the same thing would be true of silver eagles. Most of my career, they were $2.80 over the price of silver or so. So that's what we would buy them back from the public for. We would sell them for $3.39 over or whatnot. During the pandemic, I would have paid people 11, 12, 13 over spot for over 3 years to buy those silver eagles. I would have paid people over $200 over spot to buy gold eagles. So we saw it transition to more of a supply demand relationship with premium. I believe very strongly that is where we will ultimately go again, because the public in large, the retail public, has been absent from the accumulation of gold and silver, which is being wickedly accumulated by the most well-informed traders in the world. Starts up here, and it will trickle down just by the very fact that getting the COMEX bars is becoming harder to get, which is really the genesis of the coins. They buy the bars, they melt them down, they turn them into coins and sell them to the public. Well, if you can't get the bars very easily, then it starts to trickle down. So yeah, in a roundabout way, I expect to see as we get closer to the end of summer, right? And typically, as you get towards Labor Day, the price really starts to move higher. I would suspect as we get through the summer, we would expect, if things continue to move the way they are, premiums to move much higher. Well, there's a 90% correlation throughout all of history between gold and silver. Typically, you're right. Gold goes first, silver goes further. You know, to me, it all boils down to the military-industrial complex. And the question really is, why have you had a handful of Western commercial banks holding down the price of silver? That's really the biggest issue. Why is there, for example, in London, roughly 260 million ounces of silver standing behind what amounts to 2.9 billion ounces of silver trading per day against 260 million ounces? And the rehypothecation on COMEX, why do you have this massive short position by Western commercial banks? Why are they holding it down in an environment where India has purchased about 900 million ounces of silver over the last 5 years, where China is the second largest producer of silver in the world? And they're admittingly flying all around Latin America, in particular Peru, and buying all the doré and the concentrate from the miners, disintermediating the market. This is from the second largest producer in the world. Why is Russia adding it to their strategic stockpile? Why are we seeing huge inflows into the United States? Massive amounts. COMEX delivered 50 million ounces of silver on the first day of the March delivery. This is because silver is very important, and it has become, I think, realized. And it used to be in the supply-demand numbers. They used to put silver in the Silver Institute supply-demand numbers for military. They don't any longer. And, you know, I gave a speech at the Vancouver Resource Investment Conference a few years ago and said there's 500 ounces in the tip of a tomahawk. And a man came up to me after the presentation and said, I work for the DOD. You're right, there is silver. I don't know if there's that much. And he said, I'll get back to you. He didn't, but I saw him the following year, 2 years ago, and he said, you're right. I'll be damned. There's 13 to 14 kilograms in the tip of every one of these missiles, Patriot and Tomahawk. And silver is needed to make high-tech weaponry. And I would ask you to think, why would a handful of Western banks in a market that is so small have the largest concentrated short position in any commodity ever traded on COMEX in silver, and a wickedly rehypothecated position in London that is now being exposed? It is, I believe, because these institutions, the military-industrial complex, needs cheap silver in order to make high-tech weapons. That's being exposed. I really do believe that. I think silver will outperform people's expectations as a result of it. And very much like the disconnect that we've, has left the people who own mining shares frustrated. I see the same thing with silver, and that's capital always chases returns. Once the broader investors realize that, whether it be in mining shares, that the companies are throwing off serious cash flow, or that silver asymmetrically has the lowest downside and best upside maybe of any asset on the planet, it will catch up. And from a standpoint of technical analysis, the cup and handle formation that's almost 40 years in the making is as strong as anything I've ever seen. It's enough to drive you insane, but it will catch up. And probably, if history if past is prologue, you'll see silver outperform gold handily here, maybe even as soon as close to the end of the year. It's getting to that point where it's really, really difficult to continue to hold down silver in an environment with naked shorting, where there's not enough bars to cover when there are people standing for delivery. Like I said, in London, 260 million ounces, they call it the float, yet they're trading 2.9 billion per day. That doesn't work out. And that's why you're seeing these deliveries, and that's why you're seeing the LBMA go from T+1 to T+8 weeks.